And as mentioned, U.S. markets have the day off for American Thanksgiving, but they did all end in the green yesterday after that volatile week last week. So what's next? Let's go to Michael Greenberg of Franklin Templeton Investment Solution. Thanks for joining us today.
Hi, Marilla. How are you?
I'm good. And investors have been waffling on AI lately. Do you think investors are being more discerning about where they're putting their AI money, or just nervous overall?
Yeah, I think there's obviously some nerves when you see these stocks doing what they've done, when you see some of the valuations. It does make it a little bit more challenging to foresee sort of the same strong level of returns that we saw going forward. That being said, our view is that we're probably still in the early innings of the technology, and that technology feeding its way through the economy, helping with productivity, helping with earnings, and helping with profitability. So, in some respects, I think there's still potential room. We would probably recommend not putting all the eggs in one basket and being a bit more diversified. But our view is that there's probably still some merit to that theme.
Do you feel like the race is beginning to narrow a little bit? There are some winners and some losers?
Yeah, I mean, if we look at it directly at the actual main tech names that are really directly implicated in AI and the investment cycle and CapEx, probably. But I think one of the things we're thinking about is, as this technology starts to diffuse to regular everyday companies, to different industries, to different sectors, it's going to be something that's going to start to have to be considered when you're doing your analysis on retail companies, on industrial companies, because those that are going to be able to implement this technology more efficiently than their peers are probably going to have a leg up as it pertains to costs, cost management, profitability, and these sort of things. So although maybe at the very, very tippity top, it's a little bit more narrow with some of these Mag 7 type companies, I think we are going to start to see it diffuse a little bit broader in the economy and within the stock markets.
Okay, so how do you see the AI story evolving next year?
Again, I think we're still going to need the picks and axles. We're still going to need the chips. We're still going to need the data centers. So, those that are directly involved there, should still be doing well. I think also when you start to look at some of the bottlenecks that could start to produce because of, the build out that we're seeing, there's going to be some indirect beneficiaries as well. And I think, that's where Canada probably could benefit, just given our natural resources. The electrification of the grid and the demand for energy is probably not going to go away. So I think there's going to be some indirect winners there, as well as, again, maybe broadening out within the corporate sector itself. So companies that are not necessarily directly related or direct AI plays, but that can implement that technology to do whatever they do a little bit better, a little bit more productively, that could be some opportunities, because some of those parts of the market, the valuations are a little bit less challenging. So there's potential for a little bit more upside, a little bit more broadening in the markets as well.
Are you surprised we haven't seen big bottlenecks yet, considering the pace of development?
It's hard to say. I mean, I think it does take time. I mean, a lot of these plans take time to implement. Also, I think what we're seeing is a lot of these, just taking data centers for an example, bypassing the grid. So you're seeing, record orders for gas turbines. You're seeing in communities where these things are being built, looking for ways to produce their own energy. I think it's still a little bit early. There's still a lot of build out to come. So I think we will see more and more of those bottlenecks. But also, I wouldn't, discount the technology improving, potentially the energy efficiency improving over the long term, where maybe it's not just a straight line energy demand that we're drawing today, but maybe there is some curtailment of that. That being said, I think it's still pretty clear that the plans as they are today are going to put some stresses on the energy infrastructure and energy supply, and could create some bottlenecks in the past, which again could be profitable for certain parts of the market.
Yeah, there also could and likely will be stresses on the labor market. How do you see that evolving?
Yeah, and I think if what you're referring to is potentially, AI taking over jobs and that sort of thing, that's clearly a concern. One of the things with new technologies is over the short term, there can clearly be some dislocation in employment, in jobs, and job demand, and job supply. But typically over the long term, when we see these types of technology advancements, they actually tend to create jobs. Now, that dislocation over the short term needs to be managed. I think it's one of the potential risks around the AI implementation that we're sort of expecting. It's unlikely if there's a lot of unemployment created because of AI technology influencing the job market, that people will take that sitting down, and that dislocation in the job market could, show up in political regulations or other pushbacks. So, I think it's not without its risk. I think it's clearly a really important theme in the market, really important investment theme. But again, we want to be wary of some of the challenges to the implementation of this technology and this broad theme, and hence, the comment earlier about not necessarily putting all of our eggs in this basket from a portfolio construction standpoint.
Okay, so that being said, should investors stay focused on North America?
We would say you definitely want to still maintain some North American exposure. Canada gives you that unique resource exposure, some interesting bank and finance exposures. The U.S., of course, innovation. But when we look broader, we do think there's some opportunities in places like Europe, emerging markets. Valuations are a little bit less challenging. Also in countries like Europe, Germany, for example, and others, we're seeing really massive fiscal spending to improve infrastructure, improve supply chains, improve productivity. And these are markets that are, have much less difficult valuations compared to, say, the U.S. Unlocking some of that valuation gap could mean some outsized returns for investors relative to some of the North American markets. So, we are suggesting that taking but not abandoning some of your profits from the U.S., where probably you've done quite well over the last number of years, and reinstituting some of that money into places like Europe, emerging markets, does make some sense. Again, diversifying outside of the U.S. and looking for some opportunities in those other markets is in our view, a good way forward.
When building a portfolio, then, what kind of framework do we need to adopt? Because things are changing so quickly.
I think we need to think about some of the big secular themes and some of the big secular risks. I think you still need growth in your portfolio. We do still think equities, whether it be public or private markets, are what you want to lean on for that growth. When you look at fixed income, we think with the higher yields and the somewhat steeper yield curves that we see, that starting yield level does give you a little bit more income and is still a good hedge against recession risk or growth risk. I think one of the risks that we do see coming forward in the next number of years is potentially a little bit higher inflation. So we also want to look at asset classes or tools that can help us manage a potentially slightly higher inflationary environment. That can be things like commodities. It could be private assets like real assets, private infrastructure, private real estate, that sort of stuff. So thinking about, how can we take advantage of upside in markets? How can we, hitch our cart to growth? But also, what are some of the risks that we see, and what do we want to have in the portfolio to buffer some of those potential risks as well? And again, have a much more sort of balanced experience with our portfolios.
Michael Greenberg, thank you very much for joining us on The Close. Michael is with Franklin Templeton Investment Solutions.